Listen, something just happened in the silver market that has every major institution scrambling right now. And if you own physical silver, or you've been thinking about it, the next 72 hours could determine whether you're positioned correctly for what's coming, or whether you're about to watch from the sidelines as one of the biggest wealth transfers in modern history unfolds without you. I'm going to show you exactly what's happening behind closed doors. The data that just came across my desk this morning, it's not making headlines yet, but it should be. Because what we're seeing right now in the silver market, it's never happened before. Not in 2011 when silver hit $50. Not in 1980 when the Hunt brothers nearly broke the market. This is different, and the warning signs are flashing red. Let me start with what triggered this. 3 days ago, the Shanghai Futures Exchange reported something that made every trader I know stop and take notice. Physical silver inventories dropped by 847 tons in a single week. Now, you might think, okay, inventories go up and down. What's the big deal? Here's the big deal. That's the largest single-week drawdown in the exchange's history. And it's happening while COMEX inventories in New York are sitting at 25-year lows. Think about what that means for a second. The two largest silver exchanges in the world are simultaneously running low on physical metal. And I'm not talking about paper contracts. I'm talking about actual bars that you can hold in your hand. The stuff that matters when the music stops. But here's where it gets really interesting. Last month, I was looking at the Commitment of Traders report, the COT data that shows us who's positioned where in the futures market. And what I saw made my jaw drop. Commercial traders, these are the big banks, the institutions that actually handle physical metal. They've reduced their short positions to levels we haven't seen since 2019. You know what happened after 2019? Silver went from $14 to $30 in less than a year. Now these commercial traders, they're not in this market to speculate. They're hedging real physical positions. When they're covering shorts aggressively like this, it tells you something. It tells you they're worried about their ability to deliver physical metal if they get called on those contracts. They're seeing the same supply crunch that's showing up in Shanghai and New York, and they're getting out of the way. And then there's what happened in India 2 weeks ago. India is the second largest consumer of silver in the world, right behind industrial demand from China. The Indian government just announced they're removing import duties on silver. Completely. Zero tariffs. You know the last time they did something like this? Never. They've never removed silver import duties entirely. They're essentially opening the floodgates, inviting their population of 1.4 billion people to buy silver without penalty. Why would they do that? I'll tell you why. Because they're watching the same thing everyone else is watching. They're watching the dollar-denominated debt system start to crack. They're watching their own currency, the rupee, lose purchasing power. And they're giving their citizens a way out, a way to preserve wealth in something real, something that's been money for 5,000 years. But let's talk about what's really driving this, because the supply situation is only half the story. The other half is what's happening with demand, and this is where it gets absolutely wild. 2 months ago, Bank of America released a research note that didn't get nearly enough attention. They projected that industrial demand for silver is going to increase by 40% over the next 3 years. 40%. And this isn't speculation. This is based on actual orders and production schedules they're seeing from solar panel manufacturers, EV battery producers, and 5G infrastructure buildouts. Here's something most people don't understand about silver. Unlike gold, which is primarily a monetary metal, silver is consumed. It gets used up in industrial applications, and it's gone. Every solar panel that gets installed on a roof contains about 20 grams of silver. Every electric vehicle uses between 25 and 50 grams. And we're not talking about a few thousand units here. We're talking about millions of solar panels and millions of EVs coming online every single year. The Solar Energy Industries Association just released their forecast. They're expecting solar installations in the United States alone to triple by 2027. Triple. And every single one of those panels needs silver. There's no substitute that works as well. They've tried. Copper doesn't have the same conductivity. Aluminum doesn't have the same reflectivity. Silver is irreplaceable in these applications. Now, here's where the math gets really interesting. Global silver mine production is about 830 million ounces per year. That number has been basically flat for the last 5 years. Meanwhile, total demand, industrial plus investment, is running at about 1.1 billion ounces per year. You see the problem? We're running a deficit of roughly 270 million ounces every single year. And that deficit is being filled by above-ground stockpiles that are rapidly depleting. The Silver Institute estimates that above-ground inventories available for industrial use are down to about 1.2 billion ounces. At the current deficit rate, that's less than 5 years of supply. And that's assuming demand doesn't increase, which we know it will. But wait, there's more. And this is the part that should really concern anyone who doesn't own silver yet. We're starting to see the first signs of actual physical shortages at the retail level. I've been talking to dealers across the country, and they're all telling me the same thing. Premiums are rising, delivery times are extending, and the big wholesalers are starting to ration supply. One dealer I spoke with in Texas told me that 3 weeks ago, he could get American Silver Eagles for $3.50 over spot. Today, he's paying $6 over spot, and he can only get half the quantity he wants. That's not a market that's functioning normally. That's a market that's starting to break. And here's something that nobody's talking about. The U.S. Mint just announced they're limiting production of Silver Eagles for the rest of the year due to blank shortages. The blanks, those are the raw silver discs that get stamped into coins. The Mint is saying they can't get enough blanks from their suppliers. In other words, even the United States government is having trouble sourcing physical silver. Let me paint you a picture of what happened the last time we saw dynamics like this. It was 2008, right after the financial crisis. Silver was trading around $9 an ounce. Everyone was panicking about the banking system, about the dollar, about whether the whole thing was going to collapse. And smart money started moving into physical precious metals. Within 3 years, silver went from $9 to $50. That's a 455% gain. And it wasn't because of some speculative bubble. It was because people woke up to the reality that paper assets, the stocks, the bonds, the currency in their bank accounts, all of that was at risk. And they wanted something real, something that couldn't be printed or inflated away. But here's the difference between 2008 and today. In 2008, we weren't running a 270 million ounce annual deficit. We weren't seeing industrial demand exploding because of green energy mandates. We weren't watching central banks around the world actively trying to move away from the dollar. All of those factors are new, and they're all bullish for silver. Speaking of central banks, let's talk about what they're doing right now, because this is crucial. Last year, central banks bought more gold than any year since 1950, over 1,000 tons. China, Russia, India, Turkey, they're all accumulating. And while they're buying gold for their reserves, you know what's happening in the private sector in those same countries? They're buying silver. The Chinese government has been very clear about their strategic goals. They want to reduce dependence on the dollar. They want to build a commodity-backed trading system. And silver is a critical industrial commodity that they need for their manufacturing base. So while the People's Bank of China is buying gold, Chinese citizens and Chinese companies are hoarding silver. I saw a report last month that showed Chinese silver imports hit a record high in the first quarter of this year. They imported over 1,800 tons in just 3 months. That's more than they imported in the entire year of 2019. And it's not slowing down. If anything, it's accelerating. Now, let me take a quick detour here because this is important. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, that kind of thing, you need to understand that there are ways to get physical precious metals into those accounts without triggering taxes or penalties. I put together a free guide that walks through exactly how gold IRAs work, what the rules are, how to set one up properly. It's in the description below. No obligation, just information that could be valuable if you're thinking about protecting your retirement savings with real assets. Worth checking out. All right, back to what's happening in the market right now, because there's another piece of this puzzle that's absolutely critical, and it has to do with the relationship between gold and silver. Right now, the gold to silver ratio is sitting at about 84 to 1. That means it takes 84 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1. And in times of real financial stress, it's gone as low as 30 to 1. During the 2011 silver spike, it briefly touched 32 to 1. What does that tell us? It tells us that silver is dramatically undervalued relative to gold. And when that ratio starts to compress, when silver starts catching up to gold, the moves are explosive. We're not talking about 10% or 20% gains. We're talking about silver doubling or tripling, while gold goes up 30% or 40%. And there are signs that compression is starting. In the last 6 weeks, silver has outperformed gold by a significant margin. Gold is up about 8% during that period. Silver is up 15%. That's the kind of relative strength that marks the beginning of a major move. But let's talk about the elephant in the room. The thing that everyone's worried about, but nobody wants to say out loud. What happens if there's an actual default on the COMEX? What happens if the paper market breaks? Here's how the silver market works, and this is important to understand. The vast majority of silver trading happens in the futures market. paper contracts that represent silver, but aren't actually backed by physical metal. The COMEX in New York is the primary exchange for these contracts, and the way it's supposed to work is that if you hold a contract to expiration, you can take delivery of physical silver. But here's the dirty secret. Most contracts never go to delivery. They get rolled forward or cash settled. The whole system is built on the assumption that only a small percentage of contract holders will ever actually demand physical metal. It's fractional reserve banking, but for silver. Now, what happens if that assumption breaks? What happens if a large number of contract holders suddenly decide they want physical delivery? The exchange has two options. They can either deliver the metal, which would drain their inventories to zero in a matter of weeks, or they can force cash settlement, which would essentially be an admission that the paper market is a fraud. We came very close to seeing this happen in March of 2020. During the COVID panic, the spread between paper silver and physical silver blew out to over $8 an ounce. You could sell a paper contract for $14, but if you wanted to buy a physical coin, you were paying $22. The market was dislocated, and it took months for that spread to normalize. But imagine if that dislocation had persisted. Imagine if the COMEX had actually run out of deliverable silver. The paper price would have become meaningless. The only price that would have mattered was the physical price, and that price would have been set by whatever buyers were willing to pay to get their hands on real metal. That's the scenario that keeps the big banks up at night. Because if the paper market breaks, if confidence in these contracts evaporates, there's no telling how high the price could go. We're talking about a market that trades billions of dollars in paper contracts every day, but only has a few $billion worth of physical metal backing it up. The leverage is enormous. And here's what's really concerning. We're starting to see the early warning signs of stress in that system. Delivery notices on the COMEX have been running at elevated levels for months. More contract holders are standing for delivery instead of rolling their positions. That's exactly what you'd expect to see if people were losing confidence in the paper market. There's a guy named Ted Butler who's been analyzing the silver market for decades. He's been warning about manipulation and concentration in the futures market for years. And one of the things he's pointed out is that a small number of large traders hold massive short positions in silver. These aren't hedgers. These aren't commercial producers. These are speculators who are essentially betting that they can suppress the price and profit from it. But what happens when those short positions get squeezed? What happens when the price starts rising and they're forced to cover? We saw a preview of this in early 2021 with the whole Wall Street Bets silver squeeze attempt. The price jumped from $25 to $30 in a matter of days, and it wasn't because of any fundamental change. It was purely because of short covering and momentum buying. Now imagine that happening in a market where physical supply is actually tight, where industrial users are competing with investors for available metal, where central banks are buying gold and their citizens are buying silver. The potential for a short squeeze that sends prices to levels nobody thought possible, it's very real. Let me tell you about something that happened in the palladium market a few years ago, because it's instructive. Palladium is another precious metal, used primarily in catalytic converters for cars. In 2018, it was trading around $1,000 an ounce. Then, supply got tight. Auto manufacturers needed it for emissions controls, and there wasn't enough to go around. By early 2020, palladium had hit $2,800 an ounce. It nearly tripled in less than 2 years. And the reason was simple. Physical shortage, industrial demand that couldn't be met by current production, and a market that was too small to absorb the buying pressure. Silver is a much bigger market than palladium, but the dynamics are similar. Industrial demand is rising, supply is constrained, and if investment demand kicks in on top of that, if people start viewing silver as a monetary hedge the way they view gold, the price could go parabolic. And there's reason to believe that investment demand is about to surge, because what's happening in the broader economy right now, it's creating the perfect storm for precious metals. Inflation is running hot. The official CPI number says 3.5%, but anyone who buys groceries or pays rent knows the real number is much higher. The dollar is losing purchasing power, and the Federal Reserve is trapped. They can't raise rates high enough to kill inflation without crashing the economy, and they can't cut rates without making inflation worse. Meanwhile, the national debt just crossed $35 trillion. That's trillion with a T. We're adding $1 trillion to the debt every 100 days now, and there's no political will to stop it. Both parties are committed to spending money we don't have on programs we can't afford. At some point, the bond market is going to say enough. At some point, foreign buyers are going to stop funding our deficits. And when that happens, the Fed will have no choice but to print money to cover the shortfall. That's when inflation really takes off. That's when people start looking for alternatives to the dollar. And silver, along with gold, is the ultimate alternative. It's been money for thousands of years. It can't be printed, it can't be debased, and it has intrinsic value because of its industrial uses. I want to share a story with you that I think illustrates what's at stake here. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, silver was trading at about $1.50 an ounce. Over the next 9 years, as inflation raged and the dollar lost value, silver went to $50. That's a 3,200% gain. Now, I'm not saying silver is going to $50 tomorrow, but I am saying that the conditions we're seeing today, the monetary instability, the supply constraints, the industrial demand, they're similar to what we saw in the 1970s, and if history is any guide, silver could be on the verge of a massive move higher. But here's the thing, and this is the warning that silver owners need to hear. If you own silver, you need to be thinking about your strategy. Are you holding physical metal, or do you own paper silver through an ETF? Because if the market breaks, if we see a real shortage, those two things are not going to trade at the same price. Physical silver, the coins and bars you can hold in your hand, that's going to command a premium. Maybe a big premium. We saw this in 2020 when premiums hit $8 over spot. We could see it again, only worse. And if you own paper silver, if you own shares in SLV or one of the other ETFs, you need to understand what you actually own. You own a claim on silver that's held in a vault somewhere, but you don't own the silver itself. And if there's a run on physical metal, if everyone tries to redeem their shares at once, there's no guarantee you'll be able to get physical delivery. The prospectus for SLV actually says this. It says that in certain circumstances, the trust may deliver cash instead of silver. Think about that. You bought silver as a hedge against currency debasement. And in a crisis, they might just give you more currency instead of the metal you thought you owned. That's why physical possession matters. That's why owning coins or bars that you can store yourself, or in a secure vault that you control, that's the only way to truly own silver. Everything else is a derivative. Everything else is a promise that might not be kept when it matters most. Now, let's talk about timing, because the question everyone wants to know is, when is this going to happen? When is silver going to make its move? The honest answer is, nobody knows for sure. Markets can stay irrational longer than you can stay solvent, as the saying goes. But what I can tell you is that the setup is there. The fundamentals are there. The supply deficit is real. The industrial demand is real. The monetary instability is real. And we're starting to see the technical signals that suggest a major move is coming. Silver just broke through resistance at $28 an ounce. That was a level that had held for months. And when you break through resistance like that, especially on increasing volume, it often marks the beginning of a new trend. The 50-day moving average just crossed above the 200-day moving average. That's what technicians call a golden cross. And historically, when silver forms a golden cross, it's followed by significant gains over the next 6 to 12 months. But more important than the technicals are the fundamentals. And the fundamentals are screaming that silver is undervalued. At current prices, silver miners are barely profitable. Many of them are losing money. And when an industry can't make money at current prices, one of two things happens. Either production shuts down, which makes the shortage worse, or prices rise to a level where production becomes profitable again. Given the industrial demand for silver, given how critical it is for solar panels and EVs and 5G infrastructure, I don't think we're going to see production shut down. I think we're going to see prices rise significantly. And when they do, the gains are going to be concentrated in physical metal, not in mining stocks, which come with operational risk and management risk, not in ETFs, which come with counterparty risk, but in physical silver that you own outright. There's a concept in investing called asymmetric risk reward. It means you're risking a small amount to potentially gain a large amount. And right now, silver offers one of the best asymmetric opportunities I've seen in years. If I'm wrong, if silver doesn't take off, what's the downside? Maybe it trades sideways for a while. Maybe it dips back to $24 or $25. But it's not going to zero. It has industrial value. It has monetary value. There's a floor under the price. But if I'm right, if we're on the verge of a major supply squeeze and a monetary crisis, the upside is enormous. We're talking about potential gains of 100%, 200%, maybe more. And that's not speculation. That's based on what silver has done in previous cycles when similar conditions existed. So here's the warning for silver owners. If you don't own any yet, you're running out of time to get positioned. The signs are all there. The supply is tightening. The The demand is rising, the monetary system is unstable, and the price is starting to move. And if you do own silver, make sure you own the right kind. Physical metal that you control. Not paper promises. Not derivatives. The real thing. Because when this market moves, and I believe it's going to move soon, the difference between owning physical silver and owning a paper claim is going to be the difference between participating in one of the greatest wealth transfers in history and watching it happen from the sidelines. The clock is ticking. The inventories are draining. The deficit is widening, and the warning signs are flashing red. This is not a drill. This is the real thing. And the time to act is now, before the crowd figures out what's happening and it's too late to get in at reasonable prices. Don't say you weren't warned.